Welcome to ForexTV.com. Today is Tuesday, January 13th. I'm Kathleen Reddington with your New York Forex Market Buzz. The dollar hits one-month highs on the euro. And now for a look at the latest headlines from the CEP News Desk. The U.S. monthly trade balance shrunk much more than expected in November, narrowing to the smallest monthly deficit since November of 2003. Both trade components took a hit in the month, with imports taking a major dive. The trade balance narrowed substantially to negative $40.442 billion in November, a 28.7% reduction from the prior month's negative $56.69 billion balance. The UK visible trade deficit grew against expectations to £8.3 billion in November. Expectations had been for the trade deficit to narrow to £7.5 billion from October's £7.6 billion level. Sliding energy prices helped push the value of Canada's imports and exports lower in November, with the country's trade balance falling to $1.3 billion Canadian dollars. That was less than half the $3 billion consensus estimate of analysts and down substantially from the revised $2.3 billion Canadian dollars in October. Today we are joined by Derek Frey of ONF Futures and Options. Hi Derek, how are you today?
Good, how are you doing?
All right, so the U.S. trade deficit surprised economists by shrinking more than expected. What do you make of this trade deficit data?
Honestly, it's kind of a minor number, to be frank about it. It wasn't an unexpected number. We kind of had this one baked in the cake, if you will, and it's been a known quantity for a while that the trade deficit is continuing to, well, to give us numbers like this. So it doesn't really change anything too fundamentally. I don't see any major fundamental shifts here on my screen, at least, or reactions therein. So I kind of see it as just more noise for the short term. The bigger news, of course, is ECB and Trey later this week.
All right, and touching on the ECB, the dollar is wasting no time gaining on the euro on the upcoming ECB announcement. I want to know what your euro-dollar strategy is.
Yeah, okay. ECB, of course, Trey has been the biggest hawk of pretty much all the central bank heads for the last few years, really, or the last year at least. And he's expected to continue his kind of hawkish rhetoric for the most part. Everyone, more or less, the consensus estimate that I've seen at least is for them to cut by half a point from 2.5% down to 2%. And the ECB is mandated to have a inflation/growth rate around 2%. So that kind of falls in line with what they're supposed to be doing. We all know that they're not achieving those numbers, but for the most part, we don't really see I'll be honest, we're looking at this pullback in the euro as a buying opportunity ahead of Trey's comments. We've seen a lot of kind of, in the stock market, they have this term called price to perfection, where a news event has to come out absolutely perfect or the market will sell off. We're in the 180-degree mirror image of that, opposite image of that right now. We have what I've been kind of terming price to destruction, where the news has been just so bad, everything that comes out, whatever side of the pond it is or whatever, it really doesn't matter anymore. The news is just continuing to be, bad heaped on top of worse. So now we're in this environment where traders are expecting bad news now. So anything less than the worst, absolute worst case scenario tends to give you a counterintuitive move. So here we have a case where a central bank is going to be lowering interest rates, which in Econ 101, at least in econ theory, would further devalue the underlying currency. But frankly, like I said, because we're reading this as price to destruction, we're going to be looking at buying the very currency that gets a rate cut. Probably at the moment it gets cut, and actually seeing it rally off of that, simply because it's not, the expectation can't be the reality just is unlikely to be as bad as the expectation, because the expectation has been hammered down so severely.
All right, and changing gears a little bit, the Standard & Poor's lowered their currency credit rating on the New Zealand dollar. What does this mean for the Kiwi?
Obviously, it's not good. It basically it means that the cost for the New Zealand Central Bank to do business with other countries is now going to go up, because they're obviously their credit rating goes down, so they're going to have to pay more money to get similar bonds and all those kind of dealings. But anyway, it's not having honestly, it's not having a massive effect on the currency itself at this time. It's definitely having a sizable move, but it's certainly not. It's not getting crushed or collapsed or anything like that. The Kiwi needs to maintain support above the lows that we put in both in November, basically in the month of November of 2008. If those lows can be held and maintained, then we could be looking at actually a head and shoulders bottom formation, which even after today's news is very much still in play. The head and shoulders formation, I mean, is still very much in play. So if we can maintain basically 52 on the Kiwi, then this could also be a kind of counterintuitive buy opportunity on the idea that it's the event is not as bad as the expectation.
All right, Derek, thanks for joining us today.
Thanks for having me.
This has been your New York Forex Market Buzz with Derek Frey of ONF Futures and Options. I'm Kathleen Reddington. Join us later this afternoon, 4 p.m. exchange right here on ForexTV.com.